Stop paying your car insurance bill until you watch this video. I'm serious. Put down that autopay confirmation, close that app, and listen to me for the next 12 minutes because there is a very real chance you are being charged double what you owed last year for a policy that actually covers you less. And the worst part, the insurance industry is counting on you not knowing why. They are banking on the fact that you will see that new premium, wince, maybe complain to your spouse over dinner, and then just pay it. Because that is what we do, right? We just pay it. Well, not today. Today I am going to show you the real reason your car insurance premium exploded in 2026, and it is not the reason they told you. It is not what the commercials say. It is not inflation. It is not because you got a speeding ticket. There is a specific, calculated, almost surgical strategy these companies deployed starting in late 2024, and it is siphoning hundreds, sometimes thousands of extra dollars out of your bank account every single year. And buried inside your policy right now, there is a clause, a tiny little paragraph most people have never read. That is the engine driving the whole thing. We are going to get to that clause. I am going to read it to you word for word, but first, you need to understand the machine behind it. And if this is your first time here, this channel exists for one reason: to drag corporate fine print into the sunlight and make it scream. So if you are tired of being nickel and dimed by industries that spent more on lobbyists last year than you earned in a decade, subscribe, hit that bell, because we are just getting started. All right, let us talk about what actually happened. The story they told you goes something like this. Repair costs went up. Car parts got more expensive because of supply chain issues. Medical claims are higher. Extreme weather events increased. And look, some of that is technically true. I am not going to sit here and tell you that a catalytic converter costs the same as it did in 2019. It does not. But here's the thing. Repair costs did not double. Parts inflation over the last 2 years has been around 11 to 14%, depending on the component. Medical claim severity went up. Sure, about 8% year over year. Weather losses were higher in certain regions. All real, all legitimate. But none of that math adds up to your premium jumping 40, 50, 60, sometimes 90% in a single renewal cycle. The numbers do not work. So where is the gap? Where is the missing money going? And this is where I need you to pay very close attention, because the answer is both simple and infuriating. The insurance industry posted record profits in 2025, record. We are talking net income figures that made Wall Street analysts blush. One major carrier alone reported a combined ratio below 90, which in insurance speak means for every dollar they collected in premiums, they paid out less than 90 cents in claims and expenses. They kept the rest. They were not struggling, they were feasting, and they raised your rates anyway. Why? Because they could. Because state regulators in most jurisdictions approved the increases based on projected losses, not actual losses. They got permission to charge you more based on what they said might happen, not what did happen. And once those rates were approved, they never came back down. Now let me introduce you to Alex and Jamie. They are a couple in their late 30s, 2 kids, both working, living in a suburb outside of Charlotte, North Carolina. Good drivers, no accidents in 5 years. One minor fender bender. Back in 2021, that was not even their fault. They had been with the same insurance company for 7 years. Loyal customers, auto pay, never missed a payment, never filed a frivolous claim. In January 2025, their 6-month premium for 2 cars was $1,140. Reasonable, not cheap, but manageable. In January 2026, that same policy, same cars, same coverage, same drivers, same address, renewed at $2,060. That is an 80% increase. No explanation in the letter, just a new number and a due date. Jamie called the company, spent 40 minutes on hold, finally got a representative who said, and I quote, "Rates have been adjusted across the board to reflect current market conditions." That is it, current market conditions. That is the corporate equivalent of saying, because I said so. But here is where it gets criminal. When Jamie asked for a detailed breakdown of the increase, the representative could not provide one. What Jamie did not know, what most people do not know, is that buried on page 14 of their policy renewal document, there was a new clause that had been quietly added during the last renewal cycle. It is called a loss surcharge eligibility provision, and in plain English, it means the company retroactively reclassified their 2021 fender bender, the one that was not their fault, as a chargeable incident under a new internal scoring model. That single reclassification bumped them into a higher risk tier, and that higher risk tier came with a base rate multiplier of 1.4. So before a single market adjustment was even applied, Alex and Jamie were already paying 40% more than they should have been, based on a fender bender from 5 years ago that they did not cause. This is not an accident, this is an architecture. Insurance companies over the last 2 years have systematically revised their internal scoring algorithms to reclassify old incidents, old claims, even old inquiries where you called and asked a question but never filed a claim, as risk indicators. They are mining your history and using it as a weapon. And they do not have to tell you they are doing it because the disclosure is already in your policy. That clause on page 14, the one nobody reads. Now, I know what you were thinking. Okay, great, I am angry. What do I actually do about this? Fair. Let us get into the fix, because there absolutely is one, and it does not involve switching to some garbage discount carrier. Step 1. Pull your current policy document, the full one, not the declarations page, not the ID card in your glove box, and search for any language around loss surcharge, chargeable incident reclassification, or internal risk scoring. Call your agent or the company directly and ask them to provide a written explanation of every factor contributing to your current rate, including your internal risk tier. They are required to provide this in most states. They will not volunteer it. You have to ask. Step 2. Order your CLUE report. CLUE. It stands for Comprehensive Loss Underwriting Exchange, and it is essentially your insurance credit score. It is a database run by LexisNexis that tracks every claim, every inquiry, every incident. You are entitled to 1 free copy per year. Go get it. Because if there is a reclassified incident or a phantom inquiry you never authorized sitting on that report, that is what is inflating your premium, and you can dispute it. The process is similar to disputing an error on your credit report, and it works. I have seen people knock 15 to 20% off their premium just by cleaning up their CLU report. Step 3, quote out, but do it strategically. Do not just go to a comparison site and pick the cheapest number. Get quotes from at least 3 carriers, and when you do, ask each one specifically what risk tier they would place you in. That reclassified fender bender that is costing Alex and Jamie 40% at their current company might be completely ignored by another carrier. Step 4, and this is the one most people skip. Ask about disappearing deductibles and claim-free discount resets. Many carriers offer programs where your deductible decreases over time if you do not file claims, and some will reset your risk tier after 3 consecutive claim-free years. But here is the catch. These programs are often opt-in. They exist. They are on the menu. But nobody tells you to order them. You have to ask by name. Check your policy code on the declarations page. If you see a code that starts with BI or PD followed by a tier number, drop it in the comments below. I will tell you exactly what it means and whether you are being overcharged. Seriously, I read these things for fun. Something is deeply wrong with me, but it benefits you, so let us go with it. If any of this just saved you even a single dollar, or even just made you mad enough to actually read your policy tonight, hit the like button. It tells the algorithm to show this video to more people who are getting fleeced right now. Now back to Alex and Jamie. Jamie, being the absolute warrior that Jamie is, did all 4 of those steps. Pulled the policy, found the clause, ordered the clue report, disputed it, got it corrected within 30 days, then quoted out with 3 other carriers and found one that offered the same coverage, same limits, same deductible structure for $1,420. That is $640 back in their pocket every 6 months, nearly $1,300 a year for reading page 14 of a document and making a few phone calls. Jamie also asked about the claim-free discount reset at the new carrier and got enrolled. So if they stay clean for 2 more years, their rate drops another 12% automatically. Alex, for the record, said he always knew something was off. He did not. Jamie did all the work. Alex brought coffee. But that is what adulting looks like in 2026. One person on hold with an insurance company, the other one Googling whether eggs are ever going to be under $4 again. Your car insurance premium did not double because the world got more dangerous. It doubled because the industry found new ways to charge you more while giving you less. And they wrapped it in jargon dense enough that most people just shrug and keep paying. That is not a market correction. That is a wealth transfer. So look, tonight, pull that policy, run your CLU report, question every line item, because the money they are taking from you is not gone. It is sitting in their quarterly earnings report, and they are bragging about it to shareholders. Now that you have hacked your car insurance and you know exactly where to look and what to fight, I need you to watch the next video, because there are 7 insurance policies that most Americans are paying for right now that are literally designed to never pay out.